The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman on this first trading day of the last week of the year, 2016, coming up real soon. And let's see, we've got the Dow down 104 at 17,447. Got the S&P down 15 at 2,045. Got the comp index down 44 at 5,003. Got gold down 7 at 1069. Silver's down 44 cents at 1393. Platinum's down 6 at 876. High-grade copper's down 4 at 208. Crude oil is down 1.5 at 3672. And bonds are up a point almost at 155. And 30 seconds. And what we've got, hi Jane the Den, yes. What we've got is the dollar is down 9 cents at 97.92. Interesting, both dollar and gold are down together. Okay, so let's go through the nitty-gritties here. What we're looking at is the E-mini is only down 14, so there's a slightly positive divergence. The E-mini 9-day moving average and 120-day moving average just been touched this morning. We've got, let me just do this here so I can get nice. There you are. So the low today is at 2,035.25. The 2,037 to 2,035 is a really important support on a short-term basis. Most importantly, what we want to see is by Thursday, the close on Thursday, a move towards the 2065 to 2080 area, somewhere close towards the all-time, the recovery high, all-time high was 2959.75, 2959.75 made back in December the 24th. Oh, I'm looking at the 120-minute chart. That was silly. The all-time high was made back in July at 2,110 round number high, but that's on the contract that we weren't looking at the time. So, okay, let's go through all this because it's the first day of the trading week, it's shortened week, and of course, remember, I've never really understood this. I understand it maybe for bookkeeping purposes, but still, to have a full trading day on the last day of the year, does that make sense? I mean, come on. Anyway, they do. So Thursday is a full trading day. Let's do this. Let's just run it. We'll go from the Dow. INDU. The Dow, as I say, is down. Now it's down 98. There is 9-period exponential moving average support at 470, I believe, 470 something, 483. 17,483. And we've got 30 points to go before we're above that. And most importantly, is the stochastic has been rallying. It's not bad. And the MACD is so close. If there is a close today, close to minus 23 on the Dow, S&P maybe that'll really help the MACD in the daily chart. Now, the 120-minute chart did make a peak B, pulled back. What was interesting is, I should have shown you this. Based on the Chapman wave methodology, remember, we're always looking for the lowest, most identifiable low bar, and then we want to get to at least a D. Well, we went to the D at 2959.75 last week. Was it on Friday? I get these things confused. We had a holiday, right? On Thursday, the day before Christmas, of course. What we're looking at here is that you've had a pullback, you're holding the support level, and there should be some kind of attempt. And I still believe my contention has been, since we came out of that trough, September, October, and went close. Didn't go to new all-time highs. We went really close towards the to the recent highs, and because of it, it tells me that very often markets that survive the September, October pullback and trade kind of close towards the yearly highs tend to close towards those highs. That's the way I'm looking at the market. That's the way my subscribers are looking at the market. Well, Let's put it this way. That's by the positions. I don't know if the subscribers are subscribing to that concept, but that's what I'm looking at. All right, so let's move on. So let's go back to the Dow. The Dow is saying that the weekly chart is made just really, this has been a consolidation phase since October. And let's just put it from this bar right here, October the 16th, where the Dow went to 17,220. From that moment on, we've been above 17,100. And as a result, it's in a trading range, forming this pattern right here. I could call it an oval. I took out the oval because it was obstructing the arch formation. And it's really important that we're looking at two patterns here. One is the arch, and the other is the positive one when the arch cannot break down in the middle and starts to move back up. And that's what we're looking at here for a potential M-shaped pattern. So I'm suspecting that if we pull out of today's slump, Friday, the late Thursday afternoon and Friday slump, that we've got a good chance of closing towards the 17,600s. We'll see. I would love for it to be 17,800s, but we'll go one step at a time. All right. Any close below 17,000, what did I say to my subscribers? I think it was 350. 17,350s would negate any strength. That would be a negative thing. So, okay, let's keep moving on. And as I say, the monthly chart, we really have to wait for the last day of the month because anything can happen until then. All that talking is just yak, yak, yak. It doesn't mean a thing. We want to see the bar close. All right. So this, of course, is applying to the charts. And the S&P is down 13 at 2,047. It's holding the 9-period exponential moving average. The MACD is much better than in the Dow because it has slightly crossed positive, and the stochastic's up at 58%, and that's not too bad. But it's the weekly chart that is holding quite well in terms of the technicals, and the monthly chart I can't talk about, but it's holding very nicely for a monthly chart under these conditions. And now let's just do this and give you parameters. If we can close anywhere into the 2055 area between now and Tuesday, we don't have to close. As long as we can get to 2055, that's 8 points higher than where we are right now. That would be a really good positive, and we could start another leg to the upside. The big deal here is that you've got to close on the S&P. You've got to not just push above, you've got to close above 2076.72. That's 300 points in the Dow, 30 points in the S&P. That's a lot of points to make up. And you've got a downtrend line, which I always respect when it's a shorter-term downtrend line. And this one is right there. And it's saying, yes, if you can close, not you, the S&P can close above 2061, that'll be really good action. All right, support, a close below 2035, and there's real trouble in terms of the short term here. Let's go. Now, we'll be finished up for the year. Time shall tell. Bill, I don't even remember what the opening price was. Let me go to the year close. The close was 2058.90. We were 11 points away from that. I'm going to say that we're going to close really pretty much within striking distance of that. That's just the way I'm feeling right now. Could be wrong, but that's the way it looks. All right. So now let's go to the S&P. Those are the levels to watch. Here's the QQQ series. QQQ, 3 of them. Yep, there it is. Not acting all that well. I think that the Qs are kind of stuck here. I've got a peak C in the weekly chart so far, leg E in the monthly chart. This is going to be very difficult. Let me give the parameters. A close at close to 113 in the QQQs would be quite positive. I'd say it would be very positive considering the strain that some of the best of the best in the NASDAQ 100, the index 100, are acting up right now. So if Priceline, Apple, you got a bunch of stocks that really have to have a nice rally. And we've already passed Christmas. How can they do it? I'm not sure, but we'll see. All right, so those are the parameters. 113.30 is what the QQQ needs to break. That'll be a positive. And on the downside, it better hold 110.50 because once it starts to break that, you're looking at that 110, 109 area as becoming a magnet. All right, so where are we? Let me just turn around to see how that's doing. Yep, that's doing nicely. Okay, QQQ. IWM, the Russell 2000. Not a great chart. Look, keep looking at the left side middle. That's the left side's daily. Weekly is in the middle. and the monthly is on the right. Now keep looking. NYA.X, here comes the New York Stock Exchange. Also not very good looking. Also in the monthly, holding that key support level. This is very difficult because you've got a divergence. You've got what's called a bifurcated market. Within markets, you've even got a bifurcated market. And I would suggest to you that the New York Stock Exchange is really the old school, and the Dow, funnily enough, right now is the school that's important. But the new school is the stocks that has the index that has the Amazons, the ones, the Googles. I'm going to Google and say I can't stand Alphabet. Why do they call it Alphabet? Just doesn't fit. Okay. So Google up 234, holding quite nicely. Nothing great, but nothing bad yet. We'll watch these real closely. Okay, let's go on. I wanted to get to the TLT. The TLT is rallying. It's up 70 cents at 122.53. Now, is the TLT, the Lehman 20-year T-bond fund, rallying because it's seeing the market weak? Or is it rallying because of other factors? I think it's really other factors, and it's in a trading range, yields in a trading range. So that's what my contention is right now. If we look at gold, gold is down. Gold is down 7 at 10.68. Look, it just can't get out of its own way. The H goes to a low case M. The weekly chart can barely make an H pattern. Nothing here, nothing to see so far. And the dollar is holding okay, but it's not great. It's up 2 cents at 98. But let me tell you, let me show you this pattern here. This pattern, I'm going to go to that one, just to show you a pattern. This pattern that makes the double arch looks like a heart, and we're on the right side of the heart. That's saying to me that the dollar's consolidating, probably has limited upside into the 99s if it can get there, but it also has good support in the 96s to 95s. And if it takes out 95, that's something completely different. But at this particular point, I just think it's holding well. The weekly chart is holding well, making another cup formation. This is a cup and a handle formation. Monthly chart still looks pretty good. So I think that the dollar is doing a lot better than many people would think. And I want you to go to EUR, USD, and we've got the euro-dollar currency pair, and there it's trying to rally off the 9-period exponential moving average. It has exactly the opposite. Now I'm going to do this just as a pattern. There goes that pattern. That's the opposite of the heart pattern. That's that soft U, double U, the letter U formation. There's the one U, and now the other one makes a rather large U. So we're going to be watching this real closely. I'd circled, I didn't give you time, but I'd circled from the arch formation from the cup formation, that the euro should get to 1.110, and it should get there somewhere around the first week of January. We'll see. That means the dollar could be pulling back a little further. Dow's at 89, S&P's down 13. Basil Chapman, Tiger Technicians Hour. My pleasure to be 877-927-6648. Love to hear from you.
It's true. Life is all about choices. At Everbank, they're making it easy for you to make a smart one with this special cash offer. Open a new yield pledge money market account with funds from another financial institution, or deposit new funds into an existing yield pledge money market account, and you could earn up to a $500 cash reward. And if you're opening a new account, you'll also get their new higher 6-month bonus interest rate, along with their yield pledge promise that ensures your yield will always be in the top 5% of competitive accounts at banks nationwide. Open a new account or add to one. It's your choice. To qualify, you must meet balance and other limited time offer requirements. Go to everbank.com/TFNN for details and deposit options, or speak with one of their banking specialists at 1-855-750-4051 for more information. You must act by December 31st, 2015 to be eligible. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. Dow's down 96, S&P down 13, and the market is kind of working hard here to find some kind of support. Let me show you something. I wanted to do this here. How can I do this? I went through, I forgot to turn to the other pages. Let me just do that if you don't mind. Here I am turning pages. This is the IBB. I spent, I couldn't even tell you how much time this weekend over the last 3 days just doing charts. While I'm doing this, let me also mention, I got talked into seeing a movie called The Big Short. It was very interesting. I mean, just a really complex set of circumstances that need to be introduced to the layperson, to the audience. I suspect just from the people that I went with, no one does anything with the market, that a lot of it was over their head. So they're really looking at it as a movie more than anything else. So when I went through it, I'm terrible when it comes to movies. I'm a reluctant moviegoer. I just don't know what it is. I guess because I do so much technical analysis, and I was a professional musician for a very long time, and I was also an artist. I just look at it critically through different eyes, so that I'm throughout the movie I kept getting either very, very bored, or after it got quite good. And there's only one a criticism that I have that I think is quite pertinent to the film, and it's a pity that it wasn't there. Because they had certain flashbacks and they were talking about the way This is to do with the whole crisis. This really has to do with the. If you read the book Tulipomania back in the 1630s with that tulip bubble in Amsterdam, in Holland, and you realize that they went from looking for the black tulip, the precious black tulip, and then it went all the way down. And just as in 2000, the year 2000 here, when you went from the quality stocks to the junk, and then junk of junk, and then son and daughter of junk, the exact same thing happened in the tulip mania, so that eventually they were selling boxes of tulips to people who had just gotten into that in the last 3 months. It's always those last 3 months that are absolutely dangerous. In the last 3 months of between the end of 1636 and the beginning of 1637, in March was the top. And, you read the same, there's no difference. It's human nature. So that lay people thought they were experts because overnight they literally became, just as in 1999 to 2000, they became really wealthy. Overnight, people became wealthy, but they never kept it. Very few that I know of, that I've even heard of, actually cashed out, and that was it. I know one person who cashed out because of a couple of reasons, but it was also basic common sense. But many people, I just have no clue. And this is a layperson I'm talking about. I just don't know who got out. Now, what was interesting is that as you went into the March of 2000, where the top was, basically you were looking at just absolute. I mean, they were clicking on eyeballs. They would get their friends to hit the computer, click, 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 because it was eyeballs that counted. There was nothing there. In fact, there was no there. So that's what happened with the mortgage. And I remember yelling and screaming back in the 1990s through the Clinton administration when they started to let loose on Glass-Steagall. When was Glass-Steagall put into effect? It was put into effect after the crash of 1929. It's always like that. When did Dodd-Frank come out? After the crash. It's always the case of the housing market. So what we've got is that we've got a movie that is explaining in certain contextual areas of the junk being sold, mortgage derivatives, and then derivatives are derivatives, and then anything that you could put into a pie, anything. Reminded me of Sweeney Todd. Anybody know Sweeney Todd? So that part of it was okay. But I thought that they should have had a couple of references to how the Glass-Steagall Act was basically just ripped apart starting from the Clinton administration. How all the way through into the 2000s you had, whether it was President Bush, whether it was Barney Frank or Chris Dodd, these are the guys that kept saying over and over, and many, many others, everybody should own a house. Everyone should have a right to own the house. And I remember yelling and screaming right here. You remember, you'll hear it on my show if you go back. And I used to say, has anybody paid for a roof? Does anybody know the cost of a house? It's not a right that everybody should have a house. Gee, I got that out by the way. All right. So we want you to look at the housing sector.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks, we're back. So I wanted to just show you the housing market here. This is the HGX, the Philadelphia Housing Sector Index. Look what happened back in July of 2005. It took a while, actually. You see, I was trying to explain this to someone the other day after the movie. The guys who started the shorting and the ones who kept on wanting to get CDOs, the ones who wanted to get instruments that they could use. Now, I remember back in 1980s, a friend of mine was doing some work with Schiller from the Case Schiller Index. And I said to him, hey, mention this to them. Mention about making up an index that you could actually short so that when we finally get our top in the market, we could short it. Took him a while to actually even get something like the index, but even this index, you can't actually short this index. It's just, it's an index. You need an instrument. So what's very important about this, look, trying to call the top was very difficult. 2003, 2004, it goes up. And then all of a sudden, remember, the market was not participating as it was going down. The NASDAQ was going down 82%. And what happened was, out of the blue, I'd never seen this, and I kept saying I've never seen this before. When a stock market crashes, normally you would see the housing sector just get clobbered and get ripped apart, pulling back more than 50%. So this was a very interesting period because money, and that money that went out of the stock market into real estate even with the big smash, you can call it, because from 293 down to 54, I would have to say that is that on a percentage basis. That is huge. So well, that kind of drop is, that's a spectacular drop. And now we've come back, and we've come back all the way from 293 in July of 2005 down to the 54 level, and that was in, I think, February. That was in March of 2009 with the general market bottom, going all the way back to 251, was it 253? 252.20 in August of this year. Well, that's still 100 points. Sorry, 252. That's still 40 points below the all-time high. This candle that we're looking at here is really, it's troubling to me. But now I'm going to draw you a little pattern that says, wait a minute, don't get too negative, because we're still waiting for the skyscraper theory, my skyscraper theory, that is. And that means you could draw this as an oval and suggest that maybe you've got a Chapman wave stalk leg formation, leg, body, a breakout above 250, 220 starts the neck. So the MACD is holding okay, a little bit negative, but flattening out negatives. There is support on the downside with limited upside. But the stochastic down to 70%. Excuse me, that's going to be a lot of work to keep going. Okay. Now, if you're looking at this chart, there's something else. You see this left side, right side price time match? Well, I'm going to move it a little bit. I'm going to move it to there, because that to me feels like that's the exact place that I should place it. So that goes there. I moved it 4 spots, 1, 2, 3. So that says it goes to August of 2016. But the trend line itself goes to next month, goes to January or February in the monthly chart. And that says that the test of 293. So this is a very important period for me. Why? Because I believe very strongly that if the market is going to be able to go higher, it's going to need at least the support. It doesn't need to have the leadership, but some support from the Philadelphia Housing Sector Index. So that at 228 right now, if there is a close below this low right here of 214.39 back in September of this year, I have to consider that an arch formation is forming in the monthly chart with a right shoulder failure pattern. So I'm watching all this really closely for the mega picture. And the mega picture says to me, I still believe that we should go to higher highs in the Dow. And I know that's a tough call. That's the call that I've made. And but I also cannot ignore certain areas of great importance. And I think that the housing sector in a certain way is. Now, let's do something else. I wanted to also look at the longer term volatility index, which I showed my subscribers to my opening call over the weekend. Look how it closed. And I kept talking about this. I kept saying, you know, I'm going to have to change that letter to an E if we start to break down in the VIX index. And most importantly, after every big spike, the moment the spike fails, it starts to make what looks like a peak, the next bars are very sharply lower. And that's what we saw in the Greek chaos of October of 2014, December of 2014, same thing, except there was a nice bounce, but it kept going lower under the 9-period exponential moving average. The big spike back in July of the week of July the 10th of this year to 20.05. Same thing, and then went down to 11.71. Then that huge aberrational China plunge interest rate fear factor back on the 24th of August. And you saw the high that was made the week of the 28th of August. That was on the 24th of August at 53.29. That was an absolute aberration. The market should have been down at 15,300 and holding down there. That was just something was, I don't know what happened with this picture. And then a big pullback to 12.80 underneath these key 9-period exponential and 200-period moving average support levels. Then the big pop-up that 1 week, that was the week of the 13th of November. Oh, no, couldn't hold it. Bam, right down below again. And then on Thursday, you saw the close, and all of a sudden, you're looking this week at a very sharp pullback. I'm sorry, last week you saw the pullback from that previous week with the Fed fears, and then all of a sudden you get the pullback, and we close way below the 200-period and the 9-period moving average. And now this week we're right on it, 1779. We're sitting right on the 9-period exponential moving average. So that's the reason why this is a very important phase. If the VIX index on Thursday at the closes underneath 1780, no, let's make it 1770, it's going to say, and the market is higher, it's going to say, whew, survived another week. And that monthly chart is starting to look very much like there could be lower prices. But I won't be saying that if on Friday the VIX, I don't care what happens. If let's say all this week is okay, and then out of the blue on Thursday there's this huge drop and the VIX spirals to the upside, a close in the 21s on the VIX index on Thursday would suggest to me, be careful. That very first week of January could see a sharp pullback. So obviously, and the reason why I'm making a big deal about this is that you're starting to see in the monthly chart. Let me show you something. Let me go to the SPY for a moment. In the monthly chart of the SPY, the MACD is still very negative. The stochastic has rallied, but it's only at 65%, not even close to 80%. When I go to the weekly chart, the MACD is still good. It's above the 9-period moving average, but look, it's getting real close to touching that slow moving average, the red line. And the stochastic's down to 65%, same as the monthly. So it's going to be the daily, and this pullback today is going to be really key, because if there is a close somewhere around here, that's not a good sign at all. But if there's some kind of a rebound, and by Tuesday the market is acting very well, even if it's selective, I don't care. That would be very important. That would suggest that the two, we had a gap down this morning in, what was it? Was it the QQQ? No. What was I looking at? Diamonds? Yeah, so the diamond almost did that, but then it had a bit of a rally. So the low of Wednesday was 174.76 in the Dow Diamond, and today's high was 174.81. We just filled it. Otherwise, that would have been so unusual. Look, it looks like one of those cowboys down in the Midwest, right? With those pants, those cowboy pants walking along. Well, these are two gap downs. And what we're looking at here is that we almost had two gap ups and then a third gap down. But third gap down hasn't worked out. So it was real close. That would have been so unusual. I don't actually remember seeing something quite like this before in all those years of doing these charts. Okay, let's get back to the nitty-gritties. So I'm talking about the levels that we're looking at, and it's going to be important for the overall market, for the slightly biased upside move that we've had to continue. But overall, if you're looking at this, we have made lower lows and lower highs, and that's continued right up until last week. So we've got to be very careful. It's going to say that a close above the high of the 23rd, 175.82, is really important this week if you are to continue. And let's go back to this chart. Remember the chart that we were looking at? That left side, let me just do this here. That left side channel with a trading band with slightly lower highs and lower lows from the May high of 18,351.36 in the Dow, and then the breakdown all the way to the 15,370 level, and then with the right side cup formation, and now we've formed the right shoulder of a pattern here. It could be an inverted one, but look, we're in this trading band, no change there. So if this MACD is able to rally sharply and get to a plus, it's minus 6.8. If we can go to plus 3 by Thursday, that'll be fabulous action with a stochastic at maybe 68 instead of 51%. That'll say, okay, great, let's see if we can test and break that. If you can break this trend line and get to Dow 16,820 by Monday of next week, that's 2016, I would have to say that's good action. But if you start to fail, then we have to consider that we're going to make an arch formation and another pattern that's similar to this. Okay, so those are patterns. Now, I did have a signal to suggest that within 2 days we should have a very strong S&P futures bounce that should be reflected in the cash index. We'll see if that's going to happen. So I've done that. I've done that. Is there a question? Yeah, good question, Dan. BRK.B. This is Berkshire Hathaway, and this is so interesting. Look, I never did finish this. I thought I had, but I didn't. So this has gone to an E, and the Chapman wave, you look for D, E, or F, and that says be really careful after the F. It's exactly what we got here. The technical started to fail, and Berkshire Hathaway goes from 138.62 on the 2nd of November down to 131.47 on the 16th. Bounces very strongly to the 200-period exponential, this coral orangey colored trend line, comes down and it starts making lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. Then it has a bounce with a slightly lower low, 129.56 on the 11th of December, and on the 18th it goes to 129.53. 3 cents lower, but that's a lower low. So we've got to be real careful, because all we need to do now is to draw this trend line in like that. Very clear. I'm going to make it nice and thick. Wait, look at that. Drew another one down here and say, uh-oh, look at that. And we've held. So we are stuck in a trading band. And that trading band says there'll be a change if Berkshire Hathaway by early next week, it mustn't be later than that, but by early next week, is if it's able to go from 133 to 137. Now, that shouldn't be 4 points in a $130 stock. In a bull move, it shouldn't be a big deal. In a bear move, it says, watch out, because 4 points down takes you below 129, and 129 is just key support, both in the daily and the weekly chart. And the monthly chart says hat-trick top. I've been talking about this for almost a year now. Hat-trick top in Goldman Sachs with the Chapman wave 2-bar reversal, 152.94, and the next bar is 151.59, and that was back in December of 2014. So far, it's under the 9-period moving average. I think that Berkshire is telling us that because, this is my own interpretation, of course, because Mr. Buffett was so public this past year, everywhere you looked, you saw his name, you saw him being interviewed over and over and over. I think there's a little bit of a loss of focus, and I think that Berkshire Hathaway stock is suffering as a problem. Can you call it suffering when it's gone only from 152 down to 132? 20 points, big deal. So you've gone down 15% in a major stock like this. It's not that. It's been under the 9-period moving average out of 1, 2, 3, 4, 5, 6, 7 months. 6 of them have been under the 9-period moving average. This is just not good action. So I'm a little concerned. So let me just look at this chart here for those of you who are trading. Yes, this is this is leg A up in the E-minis, and it's a gray A. It doesn't say that you have to go to a C and a D unless the technicals or the pattern's very good. But I do have a left side, right side price time match, and that says that if it's going to succeed in rallying, 2043.50, the high of 10 minutes past 10, that's 3.5 points to go, has to be a target, and that target should be right there at about 140. By 1:30 this afternoon, we should be pushing in that area. Actually, 1:30 should do it by 12:30. But anyway, by 1:30. I'll be right back. Basil Chapman.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Learn how to trade options with swim lessons. Brought to you by TD Ameritrade. Think or swim. Next on TFNN.
Yes, please listen to Think or Swim lessons. These are great educational tools, and I highly recommend it. Okay, so there we are, Berkshire Hathaway. I want you to do a couple of things here. You know, Apple. So now the season, the buying season for Apple is over. But look at the chart. I drew this a long time ago. It has a pattern that I call the H pattern. Let me just draw it in here. Comes down, has an arch formation. That's the lowercase h. And then has another bounce, and that goes into a lowercase m. And that's the one that becomes highly vulnerable to the downside. So at this particular point, we've only got one H pattern. We haven't yet got the other. That's the best case scenario. But I can just tell you this, that if Apple, with all the selling that's going on, etc., whatever it is not able to hold and push into the 111 area, it's at 107.18. 4 points for Apple should be nothing. Does it on the way down lately very quickly, so it should try it on the way up. But if Apple takes out 102, then all of a sudden, no, 103.50 starts to trade there for a few days during any particular week, then all we're looking at here is the low that was made at 92, the round number low back in August, that becomes a target for the price. It doesn't give you a time, although it's usually very quick. Once it gets there, it starts to its descent rather quickly. So I'm watching that, and that's going to include a drag down for the Qs of a certain percentage. So what have you got that's going to make it up? Well, Priceline took a hit. Oops, PCLN. Priceline took a hit from its 1476.42 November 5th all-time high. G in the daily, gap down after that. D in the daily, in the weekly, gap down after that. And D in the monthly, and that's that arch formation, that cup formation. That says, whoa, be a little careful, because if Priceline is unable to rally from 1267 down 5 right now to by Thursday, at least by Thursday, above 1283, the 9-period moving average, that's not a good sign. So this is a very select market right now. For my subscribers to my opening call, we've been buying. We're actually mostly long. We do have shorts, but we're mostly long. And one of the reasons is it's very selective, and the selectivity has to do with sector selectivity, even though they're Dow-type stocks. It has to do with chart formations, and it just seems to me there's enough, just enough strength in the Dow to be able to rally further. We'll see if I'm correct. Question of the den, is that Facebook one of those? Well, Facebook's acted well. It hasn't really done anything to break out. It could have a sudden spike to the upside. My thinking here is Facebook at 105, down just 2 cents. It's got a pattern that says, if it can take out that left side high of 107.75, there again, 3-4 points on the upside. For whatever reason, if there's a trigger that's able to get it to go there, all of a sudden the buyers will push it, and it'll help the weekly chart very much, because the weekly chart needs a retest of the high, all-time high of 110.65 made back the week of the 6th of November. Now, on the downside, it's the same thing. 3 points or 4 points up is very positive. 3 to 4 points down says, uh-oh, you better be careful, because Facebook's stalling. And it's an E, perhaps a peak E in the monthly chart. And the weekly technicals are weakening, but the monthly technicals are still good. So this is a mixed picture. And Google, I'm going back to Google here, not Google L. Can't stand the name Alphabet. Google's acting okay. It's still holding quite well. So, okay, we're about to wrap up. You're about to go to for the Think or Swim lesson. Enjoy it, plus all the other technicians today. So enjoy the day. I'll be back tomorrow. In the meantime, look at this. The VIX index, give it to you again. Yeah, right here. The VIX index short term is at 1757. If the VIX index starts to slide under 17 by 3 o'clock this afternoon, the coast is clear for the market to rally into Tuesday. If the Dow, if it holds in the 1757 or goes to 18, that's not a good sign.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,